Item 2. Management's discussion and analysis of financial condition and results of operations. ClearOne, Inc., the company, we, us, or our, was historically a global provider of conferencing, collaboration, and AV streaming solutions for voice and visual communications. Following the October 24, 2025, disposition of substantially all operating assets and intellectual property to Biamp Systems, LLC, the asset sale, the company no longer manufactures or sells products. Our continuing operations are now limited to fulfilling warranty and technical support obligations for legacy products. I2. Maintaining public company compliance and governance. R. Collecting accounts receivable and recovering prepaid assets. And 4. Evaluating and pursuing strategic alternatives, including a potential mergers or other transaction intended to maximize stockholder value. In September 2025, the company's board of directors approved a plan, the strategic plan, to seek the sale of a significant portion of the company's operating assets related to its product business, reduce the company's continuing operations to warranty and product support, and position the company as a reverse merger vehicle for a possible strategic transaction, a strategic transaction. Accordingly, as of September 30, 2025, we classified the related disposal group of assets as held for sale and measured it at the lower of carrying amount or fair value less costs to sell. The assets held for sale were sold in October 2025, and certain assets and liabilities related to discontinued operations remained after the October 2025 sale. See Note 2, Discontinued Operations and Assets Held for Sale. Because the planned disposal represents a strategic shift that will have a significant effect on our operations and financial results, we present the results of that component as discontinued operations for all periods shown. Accordingly, this MD&A discusses continuing operations separately from discontinued operations where relevant. Strategic actions during 2025 and 2026, July 2025, issuance of Class A redeemable preferred stock as a special stock dividend and automatic conversion of the $3 million convertible note into Class B convertible preferred stock, see Notes 3 and 4. September 2025, repurchase and cancellation of all then outstanding warrants, see Note 5. October 24, 2025, completion of the asset sale to Biamp Systems, LLC for $3.0 million in cash. The transaction represented a strategic shift that had a major effect on the company's operations and financial results. The results of the disposed component are presented as discontinued operations for all periods presented. See Note 2. March 2, 2026. Private placement with First Finance Limited, largest stockholder, for 437,500 shares, and a warrant to purchase 437,500 additional shares. See Note 11. March 9, 2026. Repurchase of 24,155 warrants from CVI Investments, Inc. See Note 5. April 1, 2026. Transition of CEO Derek Graham to a consulting arrangement. See Note 15. April 7, 2026. Termination of the Edgewater Corporate Park lease and receipt of NASDAQ continued listing deficiency notice. See Notes 9 and 15. April 10, 2026. Board approval of Class A preferred stock redemption at par. April 21, 2026. See Notes 3 and 15. April 22, 2026. Completion of reincorporation from Delaware to Nevada. See Note 1. Following the asset sale, our continuing operations generate minimal revenue and consist primarily of warranty support, collecting accounts receivable and recovering prepaid assets, public company compliance costs, and restructuring activities. Management's primary focus is preserving liquidity and evaluating strategic alternatives, including a potential reverse merger or other transaction, to maximize stockholder value. The company has incurred net losses and used cash in operations, and substantial doubt exists about its ability to continue as a going concern. See Note 1, Going Concern. Continuing operations and post-disposition plan following the asset sale on October 24, 2025. Our continuing operations are limited to fulfilling warranty and technical support obligations for legacy products. Maintaining public company compliance and governance. R. Collecting accounts receivable and recovering prepaid assets. And 4. Evaluating and pursuing strategic alternatives. We do not expect to generate material revenue from continuing operations in the foreseeable future. Warranty support activities. We retained responsibility for legacy product support and warranty obligations. The company maintains a small technical support function and limited service inventory to honor these obligations. Any immaterial service or parts revenue, if recognized, is reported within continuing operations. We evaluate warranty accruals each period and adjust estimates based on observed claim rates and resolution costs. Corporate infrastructure and compliance. We maintain a lean corporate staff, including accounting, finance, IT, and senior management CEO, CFO. Ongoing costs include audit and tax services, legal and advisory fees, SEC reporting, D&O insurance, IT licensing, and board and compliance expenses. Monetization of residual assets and settlement of obligations. Management's near-term priorities include monetizing any remaining assets, collecting receivables, settling liabilities, and completing the Class A preferred redemption. All 3 facility leases were terminated by April 7, 2026. See Note 9 and Note 15. Results of operations for the 3 months ended March 31, 2026. Following the asset sale on October 24, 2025, the company's continuing operations generate minimal revenue and consist primarily of warranty support, public company compliance, and restructuring costs. The majority of the company's historical operations are now presented as discontinued operations. See Note 2. Continuing operations. Continuing operations in Q1 2026 primarily comprise corporate activities, public company reporting, governance and compliance, warranty support for legacy products, and restructuring actions. We recorded no product revenue in continuing operations for the 3 months ended March 31, 2026. Costs of goods sold and gross profit loss. Cost of goods sold in continuing operations reflects warranty-related parts and labor and immaterial service inventory usage. With no revenue in continuing operations for the periods presented, gross margin percentages are not meaningful. The period-over-period dollar changes reflect timing and volume of warranty claims and repairs. General and administrative G&A. General and administrative G&A expenses in Q1 2026 were driven primarily by legal, advisory, and regulatory fees associated with the strategic review, disposition process, audit and tax fees, D&O insurance, and incremental accounting and compliance costs. S&M and R&D expenses in continuing operations were immaterial following the classification of the product business as held for sale. Sales and marketing S&M and research and development R&D. Following classification of the product business as held for sale, S&M and R&D expenses in continuing operations were immaterial for the periods presented. To the extent severance or other exit costs were recognized in the quarter, such costs are reflected in the relevant operating expense caption in the period incurred. Restructuring exit costs. To the extent actions met ASC 420 recognition criteria, we recorded employee termination or contract termination costs. Otherwise, such costs will be recognized when probable and reasonably estimable. Other income expense net. Other income expense net reflects interest income on cash equivalents, interest expense on the convertible note through its conversion on July 21, 2025, and immaterial gains/losses on asset disposals related to restructuring activities. Discontinued operations revenue in discontinued operations declined to $0 in Q1 2026 compared to $2,313 in Q1 2025, reflecting the completion of the asset sale in October 2025. See Note 2, Discontinued Operations and Assets Held for Sale for additional details on the components of discontinued operations. Costs of goods sold and gross profit. Cost of goods sold includes expenses associated with finished goods purchased from outsourced manufacturers, the repackaging of our products, our manufacturing and operations organization, property and equipment depreciation, warranty expense, freight expense, royalty payments, and the allocation of overhead expenses. Our gross profit decreased from 148 during 2025 Q1 to a loss of 88 during 2026 Q1. The reduction in gross profit reflects the completion of the asset sale in October 2025. See Note 2, Discontinued Operations and Assets Held for Sale for additional details on the components of discontinued operations. Operating expenses include sales and marketing (S&M) expenses, research and product development (R&D) expenses, and general and administrative (G&A) expenses. Total operating expenses in 2026 Q1 were $264 compared to $2,168 in 2025 Q1. The following contains a more detailed discussion of expenses related to sales and marketing, research and product development, general and administrative, and other items. Sales and marketing (S&M) expenses include selling, customer service, and marketing expenses such as employee-related costs, allocations of overhead expenses, trade shows, and other advertising and selling expenses. S&M expenses were $33 in Q1 2026 compared to $1,116 in Q1 2025. Both comparisons are the result of decreased sales commissions on fewer sales, as well as lowered marketing spend inclusive of the reduction in force completed in Q3 of 2025. Research and product development (R&D) expenses include research and development, product line management, engineering services, and test and application expenses, including employee-related costs, outside services, expensed materials, depreciation, and an allocation of overhead expenses. R&D expenses were $9 in Q1 2026 compared to $691 in Q1 2025. The decrease in comparing the quarterly results was due to a decrease in headcount. General and administrative (G&A) expenses include employee-related costs, allocations of overhead expenses, litigation costs, and corporate administrative costs, including costs related to operational teams. G&A expenses were $222 in Q1 2026 compared to $361 in Q1 2025. The decreases were due to decreased expenses related to the exploration of strategic alternatives and closing down facilities. Other income, expense, net includes gain or loss on disposal of assets and impairment charges related to assets being held for sale. Other income for the 3 months ended March 31st, 2026 included a $78 charge for expenses related to closure of foreign subsidiaries, compared to $0 for the 3 months ended March 2025. Provision for income taxes. During the 3 months ended March 31st, 2026, the company recorded an income tax benefit of $793, recorded in discontinued operations, resulting from the reversal of unrecognized tax benefits, FIN 48 reserves. This reversal occurred because the statute of limitations expired for certain tax years, and the underlying tax positions were no longer subject to IRS review. For the 3 months ended March 31st, 2025, the company did not recognize any tax benefit from its losses due to the establishment of a full valuation allowance on its net deferred tax assets. Net loss and outlook. Net loss for the first quarter of 2026 was $487 compared to a net loss of $2,834 in the first quarter of 2025. The improvement was primarily driven by a one-time income tax benefit of $793 recorded in discontinued operations from the release of uncertain tax positions, partially offset by the absence of revenue-generating operations following the October 2025 asset sale to Biamp Systems. Looking ahead, the company's continuing operations are expected to consist primarily of warranty servicing and technical support for legacy products, along with ongoing public company compliance and governance costs. We will continue to evaluate warranty claims experience and adjust our reserves as appropriate. In parallel, management is actively pursuing strategic alternatives, completed the redemption of the Class A redeemable preferred stock on April 21st, 2026, collecting accounts receivable and recovering prepaid assets, and continues to evaluate potential reverse merger or other value-enhancing transactions. We expect these activities to remain the primary focus for the remainder of 2026. Liquidity and capital resources. As of March 31st, 2026, cash and cash equivalents were 1 million V53 compared to 739 as of December 31st, 2025. Working capital was minimal at both dates. Cash used in operating activities was approximately 680 in the 3 months ended March 31st, 2026, compared to $2,644 in the 3 months ended March 31st, 2025. The decrease in cash used was primarily due to the absence of operating activities following the asset sale. Cash provided by financing activities in the 3 months ended March 31st, 2026 was $1,728 compared to $1,000 in the 3 months ended March 31st, 2025. Both provision to cash were the result of common stock sales. In furtherance of the asset sale pursuit, the company completed a one-time special stock dividend of Class A redeemable preferred stock payable July 18, 2025 to holders of record of our common stock on July 11, 2025, which entitles holders of the Class A redeemable preferred stock to 100% of net proceeds from any asset sale upon redemption. See Notes 3 and 15. The redemption occurred on April 21st, 2026 at par value of $2. This structure aligns stockholder interests with the strategic process but depends on the successful completion of the asset sale for value realization. See Note 3, Class A Redeemable Preferred Stock. As of March 31st, 2026, First Finance Limited beneficially owned approximately 61.34% of our common stock on an as-converted basis and has the right to nominate 2 directors to our board. This concentration may influence strategic decisions, including the ongoing restructuring and possible strategic transactions, and could affect our ability to attract alternative financing or partners.